Hello, everybody, and thank you for joining us during Lytham Partners Spring 2023 Investor Conference. My name is Roger Weiss. I'm a Vice President here at Lytham. In this panel discussion entitled Future Shock, we welcome two esteemed gentlemen whose job it is to sift through the economic and trading market landscapes and make sense of the roller coaster ride that we inhabit today. By way of introduction, we are joined by Art Hogan, Managing Director and Chief Market Strategist, B. Riley Wealth. Art is a highly respected expert with a proven track record of providing astute market analysis and strategic guidance. A frequent guest in live interviews on CNBC, Fox Business, Bloomberg TV, Art's insightful commentary and straightforward manner have made him a respected and well-known figure in the financial media for many years. Joining us as well is Ryan Detrick, Chief Market Strategist, the Carson Group. He is a recognized authority on the financial sector and is a chartered market technician known for his keen insights and ability to analyze market trends. Ryan contributes a deep understanding of investment strategies and macroeconomic dynamics. He regularly shares his insights in various national broadcast outlets such as Yahoo Finance, CNBC, Fox Business, and Bloomberg. We call the discussion Future Shock, but it's really more of a here and now. We have a laundry list of economic issues and headwinds facing us today, including the Fed's rapid and steep ratcheting up of rates, an inverted yield curve, failures of substantial banks, Silicon Valley, Signature, First Republic, and let's not forget Credit Suisse. Overall tightening bank lending standards, reduce cheap access to the equity markets, the post-pandemic hangover, and specifically COVID-induced high vacancies in office real estate, a continuing geopolitical crisis / war in the Ukraine, and a potential default to the US government. So what's that old joke? Besides that, Mrs. Lincoln, how was the show? All right, Art and Ryan, let's start talking. How should we be thinking about our current show?
Terrific. I'll take the first stab at that, and you did certainly give a long laundry list of things that are potential headwinds for markets and equities in general. I think it's always important to take a step back and say, is the news getting better or worse? And how much of everything you just mentioned is well known and well priced into equity valuations. And I would argue that the flow of news is clearly getting better. Let's just start with the Fed. And I think that's, part and parcel of a lot of the other secondary effects that we've seen. I think the Fed is clearly done raising rates, and that's good news and potentially a pretty important tailwind for markets. And the reason I think they're done is the body language of the parade of Fed speakers we've heard from have really started to get to the place where they are going to feel comfortable pausing. I certainly think that the outtake of some of the credit tightening that's happening because of the regional banks has done a lot of their work for them. Now, credit tightening is a feature, not a bug for monetary policy, especially when you want to tamp down inflation and slow things down. And I don't think they intended for this to work like this, but it's certainly going to have an effect. So I suspect that when we get to the June meeting, they're going to sit tight, and the next move they make in monetary policy is likely to cut rates, but not because the economy is in a disaster. I think it's because if you look at the path of inflation right now, whether you look at PCE or CPI, and you actually incorporate real-time data as it pertains to real estate, we likely will have a 3 handle on the core PCE and CPI by the fourth quarter of this year. And with the Fed, with a 5 to 5.25 Fed funds rate, they'll likely feel like they're too restrictive at that juncture and likely start stepping back. And I think both those things will be positive for the market. So that's what I'd kick off with.
Yeah, I'll chime in. That was great stuff. And first off, thanks for having me. I'm excited about this opportunity here. So a lot of things swirling here. You listed a bunch of bad things that have been happening. And I think the interesting about the stock market, as investors know throughout history, the stock market is a forward-looking mechanism. It tends to price in a lot of bad news. Just recently, like a couple of days ago, Gallup had a poll that came out. It listed like stocks and bonds and gold and real estate. And it said, hey, what's going to be the best investment over the next year? Stocks came in the lowest in 13 years. Now, we just had a terrible bear market last year, right? This year, yeah, we'll get into it a little more. I mean, things are doing better this year. Obviously, Dow's like virtually flat and S&P's up. We know that. NASDAQ up close to 20%. So it's not perfect, but it's really unique because, again, there's so much negativity that is out there and what's priced in and what's not. And at Carson Group, we think there are some positives. Just kind of building on what Art said. Let's talk about the Fed for a second. We're in the camp, too, that likely they're done hiking. They went from 0 to 5% in a hurry. 10 straight hikes, one of the most aggressive rate hiking schedules we've ever seen. And yes, that upset the apple cart a little bit because it hurt fixed income, which in turn caused, and you could say, some of these banking crises that we're seeing with banks that, let's be honest, maybe kind of should have been checking things a little bit closer than they were. But it's fascinating to me how you tell me three of the four largest bank failures ever in the U.S. at least have taken place in the last 2 months. Yet the S&P was higher in March and April. I don't know. Sometimes these things don't always necessarily make sense. But again, maybe it's the market's way of saying things could be okay. Now, final comment on the Fed here, or a couple comments maybe. We've been talking about this a lot, saying the Fed tends to hike until the Fed's funds rate is above year-over-year CPI. Finally, that just happened to everybody. The Fed's funds rate's 5.25, the upper range. CPI year over year is 4.9. Look at the last 8 cycles. They kept hiking until Fed's funds rate was above year over year CPI. So in other words, it's saying back in September, October, we were looking at this saying there could be more rate hikes than people think. That is played out, obviously. But now they really could take the foot off the pedal. And what does that mean to someone listening? We took a look at the last 10 times the Fed hiked rates and then stopped hiking rates. 1 year later, the S&P was higher 8 out of 10 times, up 14% on average. Yes, 1981 is in there. Yes, 2000 is in there. Stocks didn't do so well. They were negative a year later. Most of the time, though, when the Fed hikes and then stops, stocks do pretty well going out a year to 18 months. When you need to start to worry is if they start cutting. Once they start cutting, that's when maybe there's I hate to say monster under the bed, but there's more worries out there. And we've been in the camp, we don't see a cut. I know Fed Fund futures are saying there's going to be 3 cuts this year. We can get into the economy and all these things. We don't see a recession, which I know isn't the base case for a lot of people. But bottom line is, if you don't see a cut this year and the Fed's done, there are some real positives from an investments point of view and maybe even from an economic point of view as we can get into.
Good. Ryan and Art, I'm actually surprised you guys are so upbeat. Ryan, you just mentioned it. You don't see a recession coming up. I was going to ask if you thought it was going to be hard or soft. You're saying it's not going to happen. What gives you, some degree of confidence that the economy is going to keep moving forward?
Yeah, great question. I mean, so we just had a call with our advisors just earlier this week at Carson Group, and we pointed out, 6 months ago when we released our outlook for the year, we were in this camp. Now here we are about 6 months later, and we're still firmly in the camp. And believe me, things aren't perfect. We are aware. You could argue we just had a depression in housing last year. We had a recession in manufacturing. We're looking at a earnings recession, 2 straight quarters of negative earnings growth, but earnings have come in better than expected, which is what you tend to see. Bottom line, those U.S. consumer is still strong. Look at real wages, real income growth. Those things have been improving. And then you look at housing. Housing starts at a yearly high. Housing makes up everyone about 5% of GDP. Think of it like, supersized, though. Even though it's only 5%, it can really cause a lot. Last year, when GDP grew 2%, give or take, housing took off about 1%. We wouldn't be surprised at all. As rates continue to trickle lower, the Fed is likely done. Housing actually more of a tailwind that virtually no one seems like they're talking about. And then again, yes, things are worrisome, but real incomes are still strong. We're still, we made 5 million jobs last year, made over 1 million jobs so far to start this year. Manufacturing's not great, but the consumer is still strong. And let's talk about manufacturing just for a second here. My final comment on this. Manufacturing probably was in a recession, but now you look globally. I mean, look what's happening in Europe, right? I don't know if I trust the Chinese data as much as the next person, but there are some positive things taking place, specifically in Europe. I mean, everyone thought Europe this time a year ago would absolutely be in a recession right now. They're not, right? And things are getting better. European stock markets are doing really well, actually. So if manufacturing comes back a little bit, the consumer stays healthy like we think they will. It's not like we're saying I'm going to have 5% growth this year. We'll be very clear. But to say we can avoid a recession is a camp that we've absolutely been in, and we haven't changed our opinion. In fact, we feel even more firmly about it in the face of all these worries that are out there. Things aren't perfect, but we can hang in there.
Art, ball's in your court. What do you think?
I think Ryan brings up a really important topic when he talked about individual sectors can go through their recessions on their own. You can go through a rolling recession. Manufacturing clearly has done that. If you look at ISM manufacturing, it's been in contraction for 10 consecutive months. At the same time, the larger part of the economy, ISM services, has been in expansion, continues to be, but it's slowing a bit, but it's certainly in expansion. And when you really step back and say, okay, what drives the United States economy? And we're really a service-driven economy, so it's probably more important that manufacturing likely has gone through its recession already and likely is plateauing. So if you look at the data, it's starting to flatten out on ISM manufacturing, and that may well plateau enough to take it out of contraction. ISM services may cool enough, but stay in expansion such that we have a slowdown in the economy, as Ryan's describing, but not the entire economy falling into a recession. And I think that's one of the drivers. And how does that happen? Well, it happens because, to Ryan's point, jobs creation, right? So we're creating 240,000 jobs on a 3-month basis every month, and unemployment's at 3.4%. So we've got a well-employed consumer, and the consumer is 2/3 of our economic growth. And so when you put those two things together and say, well, what's going to keep us out of a recession? Think about a strong, well-employed consumer that remains confident and has just shifted their consumption patterns from goods to services. And that's what put manufacturing into the recession that it's likely coming out of now, and has kept the overall economy strong. So I agree with Ryan. I think this is an avoidable recession. And it's interesting because this is the sort of waiting for Godot recession. It's been talked about for the last, call it 5 quarters, and it's going to be next quarter, and everyone is sure of it. But I've never, in the 35 years I've been doing this, ever seen consensus so strong towards something, and that's the recession this time, where that entire group is right. So I think that it's I draw a lot of confidence in things that Ryan talks about in terms of the overwhelming negative sentiment, while the market seems to be whistling by that and just plugging along very nicely.
I'll just chime in just for a second if I could. General Patton said if everybody's thinking alike, somebody isn't thinking. Just kind of building on that. Everyone's talking about this recession, and I think it's fascinating when you consider just the crowd psychology that goes into some of these things. And believe me, the crowd can be right. I'm not saying the crowd has to be wrong, but when you break it down a little bit more, there really are some positives out there. Even though TV's right to my right there, I'm pointing over that way. They might not tell you as many positives that are out there because their job, the media's job, is to get clicks, to get eyeballs. They're not necessarily always on the same team, I guess you could say, as investors. But there really are some positives out there.
So within, I guess, a more positive view of the economy as we move forward, what does that mean for smaller companies? We're here as part of the Lytham conference. We work with a lot of smaller companies. You guys and your organizations look at a lot of smaller companies. How do you feel that those companies will do in that kind of market environment?
Well, I'll take a stab at that first, and love to hear Ryan too. For me, Ryan started off by something that was really important, saying the market's a forward pricing mechanism, right? And if you don't think we've priced in enough bad news in the small cap space, then you're not paying attention. If you were to look at the Russell 2000 right now, the entire Russell 2000 market cap is less than Apple, right? So when Apple is larger than the entire Russell 2000, it's likely time, getting very close to time, to start thinking about small cap, right? And I think whether you look at the S&P small cap index or the Russell 2000 or whatever your favorite benchmark is, I think the way this plays out is in 3 steps. First of all, effectively pricing in a slowdown, which obviously small cap is done, or I forgot how you referred to it, Roger, as like the nuclear winter for small cap or something like that. But effectively pricing in worst case scenarios, and then having news go from terrible to just bad. And I think that's the second step, where it's like, okay, the news flows start to get better. And as the news flows start to get better, investors being savvy enough to look around the landscape and say, okay, what have we missed out on? And I certainly think small cap is going to be one of the first things that they transition into. I think it's a function of, it's not going to happen overnight, but it's certainly, we're going to go from a period where we get things behind us. That ceiling gets resolved likely in September. We kick the can down the road, and then they finally get together on a budget and a debt ceiling. We stop worrying about default. That's behind us. We realize after the next several meetings that the Fed's not raising rates anymore and likely going to stay here for a period of time. So we can actually start looking at economic data through a lens that good news can actually be good news. And I think that and as opposed to that counterintuitive place that we get in a hiking cycle where good news is terrible news for everything, including the stock market. So I think we're getting closer to that point. But I certainly think that the big advantage that small cap has is they've already gone through the storm, right? And when you start looking at multiples on the 10 largest companies in the world and saying to yourself, wait a minute, is it possible that Apple is actually worth as much or more than the entire Russell 2000? I think that's really going to drive sentiment towards here's the things we've been missing out on. I think small cap falls right into that territory.
I love it. Building on the Apple versus Russell 2000, that again just happened where Apple's worth more than, now I don't know the exact number. There's not exactly 2,000 stocks in the Russell 2000, but it's pretty close. But nonetheless, Apple worth more than small caps. We just looked into this actually at Carson Group. And if you look at forward earnings, right, small caps are supposed to make about 30% more in terms of earnings over the next 12 months than Apple is. Yet Apple's PE is significantly higher. If you look at, small caps relative to large caps, price to earnings ratios, small caps are historically cheap. Now, just because look at emerging markets. We don't really like emerging markets. They're always cheap, okay? Just because something's cheap doesn't mean you want to dip your toes in. But when you consider the fact, like we started this conversation, if we can avoid a recession, all this negativity that's priced in, absolutely. I mean, why have small caps been in so much trouble the last 2 to 3 months? Regional banks, literally companies that were worth, $200, $300 a share are like gone now. All right. These regional banks have been crushed, making up a good chunk of small caps. That has hurt small cap stocks in general. But again, if you don't think we're going into recession, like we kind of laid out here, there's some really good opportunities. Actually, at Carson Group, we're overweight small caps. We run a lot of different models for our partners. We call our advisors our partners. And we have an overweight to small caps. And again, putting our money where our mouth is, if you don't think there's a recession, there's probably some really nice potential opportunities here. And if we can get past this banking crisis, and believe me, no one knows when that's going to happen. We think we're getting close, though. Just to look at the banking crisis real quickly, yes, tightening, there's more tightening, there's more concern. Banks aren't quite lending as much. But if you actually look under the surface, this is free data on like the St. Louis Fed's website in terms of like small banks, how much they're lending. It's not that far off the all-time high. Banks are still lending. People are still giving money to a lot of these small regional banks. And that's an important concept and an important thing, I think, to point out, that everyone's not just taking all their money from the small banks and putting it in your large banks. You hear that in the media, and that's the picture that's being painted. But then you look at the data, and it's not really the case. And again, that's maybe a positive too. But we need regionals to start to bottom before small caps can start to go up. And we think we're getting pretty darn close to that.
So what I'm hearing is the thaw may be happening as we're speaking right now, and the green shoots are coming. And so take a look out, because if you look out your window, in fact, spring may be here already for small cap land.
Yeah, I agree, Roger. I think that's a great way of phrasing that. I would offer up that to Ryan's point, part of the driver clearly that we knew about coming into this was going to be higher rates are more difficult for companies that need to access capital markets and borrow from banks. So part of that had already been priced in. The new surprise since March 10th is, okay, now we've got some regional banks that were poorly managed. And as an offshoot of that, they got in trouble and run into receivership and now are owned by somebody else. So that was the unexpected part. But that got priced in almost as quickly as I've seen in history of markets. It's like, okay, now let's take a look at every regional bank and see how their balance sheets look. And a great example in Pittsburgh, PNC was one of the first regional banks to report, and it's one of the largest. And they actually did such detailed work talking about their exposure to things like commercial real estate, office, et cetera, and deposit flows and how that looked. And every other regional bank that reported after that took that template or that blueprint and said, okay, let's do the same thing. So yes, we're going to be concerned about commercial real estate. That's a longer term situation. But if you actually have well reserved for that issue, which I don't think people are surprised by the fact that office occupancies are down. We've known about this for 3 years. This is a very slow moving train. I think it's a function of making sure you have good risk management. But we're seeing that throughout the great majority of regional banks. So to Ryan's point, I think this is a situation where it's only going to take a couple of small triggers for regional banks to stabilize, and for we need no other shoes to drop. Right? We don't need to hear about another bank being taken over by the FDIC. We also need the FDIC to say $250,000 of insured deposits as compared to a percentage of our total GDP, is the lowest insurance we've had since they put that insurance in. So there probably is a natural inclination for the FDIC to say we should normalize that to some level that's higher. I think that instills a lot more confidence. If you were to take it from 250 to 500, that covers 85% of the deposits and regional banks, and that in and of itself, I think, would be something that would instill some confidence and likely really start a significant rally in a very oversold part of small cap land, which is the regional banks.
Yeah, our friend Sam Stovall, I know you're a friend of Sam. Sam says if the opposite of pro is con, then the opposite of progress is Congress. So I think that's a good one. And you think about it, what you just talked about there, Art, and I don't know this is maybe out of my wheelhouse, but the last time FDIC did increase to 250,000 was like in 2008 during a financial crisis. So it's during times of stress, during times of fear is when these things happen. And we're optimistic as well that Congress can get it, everything in alignment. It really feels like the left and right are about as far as they ever could be. But when it comes to the FDIC and wanting to shore up the banking system, the idea that we can get into the debt ceiling stuff, I know maybe in a minute or two, but with just specifically on increasing FDIC over 250 to say 500,000, absolutely, we think people agree. And it's time. Just look at inflation since 2008. I mean, I don't know the exact number, but that 250 is probably worth about 500,000 when you consider just factor in inflation, not just the fact that everyone's worth a lot more money than they were. The stock market's a lot higher. Real estate's worth a ton more. It just makes sense that we should absolutely get that increase. And that could be one more thing that is necessary to help bring that confidence that we're talking about here.
Yeah, right. And one of the reasons that we would find bipartisan support for this is there's a regional bank in every congressperson's district, right? So when you think about the fact that there's 4,200 of them, and they're getting calls from the heads of their regional banks in their district and saying, hey, can we take a look at this? This makes sense. And oh, by the way, the FDIC is paid for by the regional banks and the banking system. So, if they're willing to raise it, that means we're just willing to pay more insurance to make our depositors feel safe.
When in terms of the overall economic environment, are we in the sweet spot for the economy right now for smaller companies or even bigger companies? What would you change right now about the economy to make things better? Or would you just say, I'm happy where it is right now?
I'll take a quick swing at that, Roger, and very much in the thought process of our ability to muddle through is probably the sweet spot for small caps, and by that I mean, yes, we're not going to have 3 or 4% GDP growth rate, but we may have somewhere between 1 and 2, and a Fed that's not tightening any longer. So we've got that that headwind has turned into a tailwind. And when you think about that, it's the concept in the markets of news going from terrible to just bad before it starts to get good. And I think we're right there. We're at that point where a lot of headwinds have been priced into this market, and that news flow starts to get just a modicum of more positive, and the tone shifts enough such that that's when investors start looking around and say, okay, what else works in this environment? What should I be thinking about? What have I missed? And small caps obviously fall into that territory. And I certainly think that is going to be the pivot point. It's going to be the news flows getting less negative.
Yeah, I want to talk earnings for a second here. So earnings season's winding down. Look at S&P 500 earnings for 2023. They've troughed, and they're finally starting to go higher. We've seen like 60% of companies actually issue positive forward guidance. That's S&P 500. But if you look at small caps, this is our friends at Wisdom Tree have done this research. The average S&P 500 company last quarter during earnings season beat by about 6 or 7%. So pretty good. I mean, it's pretty good size beat. Small caps beat by almost 15 to 16% on average. The average company's earnings are coming in way better than expected. It's kind of how do I word this? The earth missed a comet one more time. Everybody talking about this big recession that's coming, all these negative things, yet things have been positive. What companies, maybe not positive, things have been okay. Kind of like Art saying, things are okay. They're not spectacular, but you got to bottom somehow. And with the guidance that we're seeing and how much companies beat, it wasn't just by a little, it's by a lot, everybody. And when you have those earnings estimates going up, the price has gone down, a PE multiple, what does that mean? Well, things are getting cheaper, but there's some earnings behind it. And that's something we really like. And I don't think a lot of people are talking about that, especially how strong small caps were this earnings season relative to the historically low expectations. That's kind of how it works. You get a low bar, you beat the low bar. Wall Street's done that forever. Small caps beat even by a wider margin than anybody in their wildest dreams would have thought this time 6-7 weeks ago. And that's again, what are companies saying? What are they doing? Were they putting where the money where their mouth is? They're still seeing some positive. Believe me, you're going to list some companies that listed positive, negative things overall. But overall, this earnings season has been strong, and small caps have really been the leader there.
That's very helpful, Ryan. Thank you. Ryan, you mentioned it before, and I might as well bring it back up again. Debt ceiling, negotiations between Congress and the White House. We're seeing credit default swaps on U.S. government debt at levels that never existed before. What are you thinking about here? And, are you scared?
Yeah, I wouldn't say I'm scared, and I'm thinking we are going to kick the can one more time, but let's put a little more context behind that. 2011 is the big worry. What did we have in 2011? A Democratic president with a split Congress. As a lot of listeners might remember, 2011, we had a debt ceiling back and forth, and S&P came out, downgraded the S&P 500's debt for, I believe, the first time in history off of AAA, and we had a 19% drop in about a week on the S&P 500. Eventually, cooler heads prevailed, debt ceiling happened, and the stock market did come back. But that's what worries a lot of us, because there are some, history doesn't repeat itself, but it often rhymes, said Mark Twain. There are some similarities. Now, here's some things I think people need to know. The very first time we increased the debt ceiling, created the debt ceiling, maybe is the way to put it, 1917, the finance World War I, okay? We've increased the debt ceiling more than 100 times since then. Since 1959, Eisenhower, okay? Every president since Eisenhower's increased the debt ceiling at least 3 times. President Biden's only done it twice so far. Again, we think the third is coming. 89 times we've increased the debt ceiling since 1959 with Eisenhower. I'm not crazy about the way our country does it. I don't really know why. The only other country besides the U.S. is Denmark that does this, where Congress gets a vote on how much the country can spend. Most countries just do it as a percent of GDP. Not my gig. I wish we did it like everybody else. I think we just like drama in this country is what it kind of feels like when it comes to some of the debt ceiling things. And again, we're going to get to the 11th hour. We really do think you don't want to be going into an election year being the Congress that was behind the fact that the government potentially defaulted, potentially caused a lot of trouble. You really want veterans not to get their checks. You want to be the Congress behind that. I don't think so. So we think, we'll get past it. And again, it's not 2011 all over again, in our opinion. Art, did I cover everything? Did I miss anything there?
Yeah, I love the historical context about why we had to do this in the first place, because every piece of debt that the government issued before we entered World War I had to be approved by Congress. And you remember back then we didn't have email, and we certainly didn't have fast transportation. So to get Congress together to say, okay, it's okay to spend a couple $1 million, they'd have to be in session. So to give flexibility to the president in 1917, while we'd entered a world war, they said you can spend as much as you need to up to this level, and that's where the debt ceiling came in. And since then, to Ryan's point, we've done that numerous times, and there's a way, I think, to get out of this current cycle, and it's likely going to be enough of a compromise comes up, right, where we can pick a couple of things that the House Republicans want and say, if we do this, can we have an extension to the end of the fiscal year, which would be in September? At the same time, in parallel tracks, we'll likely approve a budget and have a debt ceiling increase, and then we'll move on from there. But to Ryan's point, we shouldn't have to do this, right? It's not, us and Denmark are the last 2 countries running that way, and it's certainly not helpful to go through this drama. It's certainly not helpful to get that close to the edge. I don't think we go over the edge in this particular go round, but there's a greater than 0% chance in divided politics that somebody could make a mistake. I think history is a lesson. We don't want to do that.
And great points. I'll just jump in. So again, 89 times we've increased the debt ceiling since 1959. So we took a look at, believe me, majority of the hikes were under a Democratic Congress. Why is that? Because we've had a majority of the time a Democratic Congress since 1959. But 26 times out of the 89, we had a divided Congress, split Congress. So just because we have a split Congress right now, and people hear, oh my goodness, in 2011 we had a split Congress, we couldn't, we got to the precipice before a lot of stuff hit the fan. you can get both sides to agree. And again, I hate to say it's politics, but it is politics, right? It's an election year. We have an economy that's showing some signs of strength. I mean, if we do let the country default, if we do have all these problems, then my whole we're going to avoid a recession, that's turned upside down. I think we absolutely could have a recession. So I just don't think people want that in Washington, and it's just how the sausage is made. It's not it's just kind of ugly behind the scenes, I guess, but we still are optimistic we can be the 27th time we have a divided Congress with a increase in the debt ceiling. It's kind of how we think this will all play out eventually here.
If we kick the can down the road, is that a good thing or a bad thing? In that, it's kicked, but then we go through these machinations all over again.
Well, yes, I think there's some good thing to it because we avoid a default, right? So that's the positive. We moved the emergency to September, but the other positive piece to this is you can actually do what you should be doing in terms of reining in spending while you're working on the next year's budget, right? And that's where it should be. All of this conversation around what we need to do to raise the debt ceiling is really about next year's budget. It's not about the money we already spent. So I think if you had the opportunity to say, let's push this down to September and work on these things on parallel tracks, and if you agree to this budget, then we get the debt ceiling, and then it takes care of itself. It's not unusual. There's certainly some precedents for doing it that way. It just seems like we ran out of money a whole lot quicker this year because of tax receipts, et cetera. And instead of having this debate in August or September, it got jammed up into our face, and June is the due date now. So yeah, I think that kicking the can down the road actually alleviates the near-term pressure. We'll likely see that manifest in the front end of the yield curve, which has exploded, with some fear that's out there. And to your point, some of the pricing on CDS, et cetera. So to me, I think, the right thing to do, if you can't get a deal done before June, is not fold. It's to say, okay, how about this? Let's take a timeout until the end of September. We'll have a temporary lift of the debt ceiling, and let's talk about the budget where all of this conversation should be.
Very good. Let me turn the tables on you both for a second. I guess you surprised me at the beginning of our conversation by talking about, after I'd given the laundry list of all the terrible bad things going on out there, and you said, we know those things. Things are actually pretty good. Is there something out there that you look at that you don't think is getting enough attention or has gotten no attention, that is something that we should be thinking about on a go-forward basis, either for good or ill?
So predict a black swan, right? One of the things that keep you awake at night. Here are three that I'll throw out there, and I think that one is our dependence on China for demand for goods and services in the global economy may have to be reset a bit. Now they've reopened in earnest, but some of the economic data, and to Ryan's point, that we can trust or not, shows that they may have a slower GDP growth. So for the second largest economy in the world to be less demanding less of our goods and services may not be priced in yet. I think that's reflective of some of the commodity price action we've seen over the last couple of weeks, but that could be a concern. If a reopening China is just not as strong as a pre-pandemic opened China because of the transition they're going through from being a net exporter to a net consuming country in their sort of 25-year plan, I think that could be an issue. And then if in fact we can't get some resolve with Russia's war in Ukraine in the near term, I think the good news about this war has been that's kept China on their back feet about doing something in Taiwan, because I think they were shocked by the response from the rest of the world against Russia for its invasion of Ukraine. And I don't believe that Putin ever thought that NATO would come together and be as strong. But we need to get a resolve, an end to this. And we need that to be somehow Russia finding a way to say they won and going back home and putting this behind us. If that was supposed to last a month or two, and here we are in month 14, not finding a resolve in the near term for that, I think would be an ongoing drag and disruptive to the global economy.
Yeah, I'll chime in. Great stuff there. I'll chime in a little different. Again, I do have a CMT, Chartered Market Technician, look at the world kind of based on supply and demand. And here's the thing I'm hearing a lot about. The stock market's up this year a lot because of 5 stocks, right? The big 5 FANG stocks. We know and love them, or maybe you don't love them, but you know who I'm talking about. That is something we hear a lot about. We would say no, it's not that simple. Okay. I'm getting a little geeky on you. Something called an advanced decline line. It's a cumulative basis, how many stocks going up versus down every single day. What we've seen in history is when these advanced decline lines are strong, market breadth tends to lead price. The Dow Jones Industrial Average advanced decline line just last week made an all-time high. All right. S&P, Dow's maybe 6-7% away from an all-time high as we speak. That says maybe the Dow could go higher. Now, the Dow's only got 30 stocks. I get it. Look at the S&P 500 advanced decline lines, everyone. Those are close to breaking out as well. So sure, I wish more stocks would participate. We wish small caps would participate. That's a big reason why breadth has been sort of weakish, because small caps haven't participated. We talked about that, but we also talked about why we think small caps might start participating. So I think the idea that only 5 stocks are why the stock market's up, I don't like that, and I know why they do it on TV. It gets your attention, but there really are a lot more companies that are going higher than not in this current environment. One other one. Everyone listening to this knows what's happened to their portfolios over the past year or so, right? Even a little longer than that. Haven't done very well. On a year-over-year basis, the S&P 500 was negative 12 months in a row. The stocks were down 12 months in a row, year over year. It just ended the end of April. Why does that matter? I went back in history. When you go long periods of time, more than a year or more, with negative year-over-year returns, what happens next? Because again, it just triggered the end of this April as we went positive year-over-year. 1 year later, last 8 times back to World War II, 8 times this happened. 1 year later, stocks were higher every single time. It's not a guarantee. We can't give guarantees. I'm just stating the facts. 8 out of 8 times higher a year later, about 15% on average. So again, lots of factors out there, but when you see the fact that things are starting to show some signs of improvement, inflation is really starting to come back down. The potential 3 handle, Art, you mentioned that. I think that's absolutely true. When you look at rents and some of those things coming down, a Fed that's starting to pause, manufacturing coming back, housing coming back, economy led by a consumer with jobs still strong, with some signs that the stock market wants to start working higher after not doing that for a while, coupled with the fact that this is like one of the more, you hate to say it, the more hated bull markets in a while. Since October, the lows off those October lows, people have really hated this rally. And from a contrarian point of view, those are positive. So I think when you factor all those things in, to us, the big worry is not the next shoe to drop. Potentially, it's a year, 18 months from now, if some good news comes in, stocks could be a good deal higher, maybe even led by small caps. Those are the things people need to be aware of and focused on. Believe me, always focus on what could happen bad. I'm not ignoring that. But we really think there could be some good things out there, and that's something a lot of investors might miss if all they're hearing is only 5 stocks are going up and the end of the world is coming.
That makes a whole lot of sense. While we have you, I have to ask, you guys, in fact, get to talk to very smart retail brokers, your partners, every day. What kind of feedback are you hearing from those folks? And what kind of insight is that giving you?
Yeah, I would tell you this. It's interesting because it seems to go in cycles over the course of the last couple of months. So the big story that everyone was burning my wire up with was is the dollar going to lose its reserve currency status in the United States, and obviously propelled by some news that China and India and Russia were willing to trade using the Chinese yuan, and obviously that was going to destabilize the dollar and only have terrible things happen. So that news story sort of started its own little narrative around the end of the dollar. So I would tell you this, that was one of the easiest conversations to have, just to describe to people why the dollar is the reserve currency of the globe, not the least of which it's backed by the largest economy in the world. It's the most liquid. We actually collect taxes and pay our debts and always have. So and we actually have rule of law. So trying to find a currency that could take the place of that is virtually impossible. And so especially if you throw in the rule of law. So with that was one of the stories I thought was really interesting. I thought the other, and this is a little geeky too, but just talking about the potential for a central bank digital currency and what that's going to mean to everybody. And again, this is a story that just blew up because a couple of people talked about it for a couple of weeks, and then everyone that was a financial advisor that was concerned about that because their clients were calling up and saying, the government's going to have all my information. It's going to be terrible, and I'm not going to have any privacy anymore. I was like, government's got most of that already, I would say, A. And B, our central bank's not heading in that direction. What they are doing is actually modernizing their payment system such that they're not only working from 9 to 5. And if they have to make payments on a Saturday, they can actually do that as a government. So it's like the government is going to open up a Venmo or a PayPal and not just be 9 to 5 and snail mail with their payments. And I think that is a step forward. But I think that the fear of those two things, some sort of central bank digital currency and the dollar losing its reserve status were the two biggest things. I think the other is, what about commercial real estate? And I think describing commercial real estate as a larger issue and not drilling down on what sectors are we talking about and saying, well, there's a lot of commercial real estate. Are you really trying to say, what about office? Because if you're saying, what about office? There's something we've known for 3 years, probably well reserved for, yes, we're going to see some property owners who want to hand their buildings back to the banks. The banks will have to go through the workout process. We've seen this. We're probably going to have some amend and extend. But commercial real estate writ large, when you think about healthcare and you think about warehouse and industrial and all the multifamily things that are actually going very well, commercial real estate in general, I don't think is going to be the biggest nightmare, but that comes up a lot. Those are the three things over the course of the last 5 weeks that I've heard the most.
Yeah, Art, I want to say this. The interns have been quiet the whole time. Do you bribe them? How does that work?
They're snoring right behind me, Ryan. It's very second.
Okay. I got a 140-pound Great Pyrenees over here snoring too. So our dogs are being good during this call. So that's good. Anyway, so I get to work with over 350 advisors at Carson Group. Just a week ago in Omaha, we had our big annual spring summit. So we got to talk about a lot of these things. And I'm with Art. Real estate and dollar were two big ones that I've heard the last, say, 2 months or so, give or take. Just remember this on the dollar. March of 2020, what happened? We remember stocks were killed, bonds were killed, even gold was killed. U.S. dollar, clean as shirt and dirty laundry, was about the only thing that went higher. As a reminder to us and the rest of the world that we still have the world's reserve currency. I hope we don't have another 100-year pandemic anytime soon to prove that, but I think it was a reminder that we still have the world's reserve currency, and that's where people are going to flock. The dollar, by the way, was up recently. It's been a little stronger. If the dollar starts to rally, that's usually more of a risk-off sign scenario. So always pay attention to the dollar. Our base case is the dollar gently will go lower here the remainder of this year, and that should again be a tailwind, I guess we'll say, for equities. But the other one, that we've heard, it's what we've just talked about. I've heard a lot about the debt ceiling, right? A lot of questions from clients about the debt ceiling. We touched on that. And then regional banks, obviously, those are the two we've heard the most about. We've already kind of covered those bases. But I think it's really important as I get to work with advisors to point out that's why I love looking at market history to kind of show, history, it doesn't repeat, but it rhymes. I use that quote already. But we've seen a lot of these things before, and we've gotten through to the other side before. Just maybe last comment on this. The Dow Jones Industrial Average started trading May 26th, not too far away, birthday, 1896, all right? It has made a new all-time high every single time eventually. We've had many bear markets. We've had many, many bad things that have happened in our country's history globally, but we've always come back. We do not think this time is going to be any different. We think the Dow eventually will get back to new all-time highs, likely before this year is actually over. And those are just, I think, things that it's important to remind advisors and for advisors to remind their clients. They said, last one, they say the stock market's the only place where things go on sale and everyone runs out of the store screaming, right? Get your lists in play. Get those stocks that you wanted to buy before. Maybe you missed them. There's going to be more pullbacks. There's going to be more opportunity, and then use this opportunity, right? Have that plan in place ahead of time. That way you don't panic when you realize, oh, this stock, I liked it. Now it pulled back. It's where I wanted it, but I'm not going to buy it because they said on CNBC, this bad thing's going to happen. Not when Art and I were on CNBC, of course, but nonetheless, have those plans in place before it happens.
I know we're getting toward the end of our time, but Art brought it up, and I have to ask, which is digital currencies, Bitcoin, et cetera. Clearly something that the regulators don't like, to say the least. In a couple of minutes, is this something that the genie is out of the bottle? Digital currencies are here to stay, or is this something that the regulators, whether it's both here or in China or someplace else, want to get rid of and ultimately will pursue it till the very end? Thoughts?
I would say, for my take, and that's a great question. I'm sorry I brought it up, and I will never bring it up again. But now that the genie is out of the bottle, as you say, Roger, I think it's important to sort of look for an analog, right? So this is a new technology, very much like the internet was a new technology in the end of the 90s. And lo and behold, when the internet, we didn't know how the internet was going to change our lives, and it took us a decade to really find out. We also had, call it 1,000 companies come public and put .com at the end of their name. I think blockchain is a new technology that likely makes our lives better and transactions better. And lo and behold, blockchain comes around, we have Bitcoin, and then hundreds of other cryptocurrencies. Now, remember, the internet actually changed our lives, but of those 1,000 publicly traded companies with a .com at the end of their name, there's likely, less than a handful that are still around. I think the same thing is going to be true for cryptocurrencies. I think we're going to live in a world where we'll have two incumbents, maybe, 2 or 3 or 4, but we're not going to have hundreds of cryptocurrencies. And I think blockchain will likely make some transactions more rapid. So I think it's here to stay. I just don't think that we're going to be able to talk about the hundreds and hundreds of different kinds of cryptocurrencies that are out there right now. I think it's going to condense and very much like the internet bubble, it will get to a place where there's winners.
Yeah, Amazon, I guess it was Amazon.com at the time, went down 96% during the tech bubble. All right, early 2000s. Now, of course, it's come back. We all know Amazon. I trip over a box every time I walk in my house, I think, from something getting delivered. Maybe some of you know what I'm talking about there. But again, the key concept being there's going to be bursts, there's going to be booms. When you look at these cryptocurrencies, we're optimistic. Everything Art just said, I think we're in a very similar camp there, that there's going to be some really big winners, right? 10 years, 20 years from now. I was in Omaha last week. I could lock my front door from my phone. People knew the internet would be big this time 25 years ago. Did they know it'd be that big where you can control things like that from your phone? Of course not. You didn't know that. So you don't really know where it's going. And, I can't really say put this much in a portfolio. Not really allowed to, but I think there's some opportunity there. Just be aware that these things are so volatile. And some of these smaller ones at the conference I was just at, that's another thing we've heard a lot about, AI and cryptocurrencies. These smaller cryptocurrencies, they can go down 50% in a week. All right. I mean, there's a reason they're like less than 1/10 of 1 penny. Okay. So just be aware of the volatility that can come from that. Sure, there can be some upside, but I think it's important to work with advisors, or at least make sure you understand what you're doing when you put a bunch of money in one small cryptocurrency that might not even be there tomorrow. And even maybe some of the more well-known ones. I don't know. But again, I think if you look at a bucket of them, there's some opportunity there. Absolutely. Just be aware. If Amazon could go down 96%, I bet a cryptocurrency could do that also. So just be aware of that.
Well, I believe we are at the end of our discussion. Firstly, I just want to thank you both so much, both Ryan and Art. This has been great, and your viewpoint certainly made me feel a lot better about where we're heading right now and where the economy is sitting. I appreciate your participation, and I learned a lot. And certainly, speaking for the folks at Lytham, we greatly appreciate your joining us. Thank you again.
Thank you.
Thank you.